Something unusual is happening in the gold market right now, and the biggest players in the world cannot simply look away anymore. For years, gold has been treated as a quiet asset that moves slowly in the background. But now the pressure building inside the global financial system is creating a situation that even the COMEX market cannot ignore. The question is not only where gold is going next. The real question is why so many powerful forces are suddenly fighting for control of the future of gold. Welcome back to Silver and Gold Watch. Today we are looking at a major shift happening in the precious metals market. Gold is sending signals that investors around the world are watching closely. Behind every price movement, there is a bigger story involving central banks, inflation, interest rates, the US dollar, and global uncertainty. The market is changing, and understanding these changes could be one of the most important things for anyone following gold and silver. For decades, COMEX has been one of the most important places for gold price discovery. Traders, investors, and institutions around the world watch COMEX futures because they influence global gold prices. But the current environment is creating a challenge. Physical demand is rising while questions about supply availability and financial stability continue to grow. The gold market today is not moving because of one single event. It is moving because many powerful trends are coming together at the same time. Investors are watching central banks increase their gold holdings. They are watching governments manage debt levels. They are watching inflation data and Federal Reserve decisions. They are watching geopolitical risks increase across different regions of the world. Gold has always had a unique role during uncertain times. It does not depend on the promise of any government. It does not rely on the strength of any single currency. It has survived wars, financial crises, and economic changes for thousands of years. That history is one reason investors continue to return to gold when confidence in traditional systems becomes weaker. One of the biggest factors affecting gold right now is the direction of interest rates. When the Federal Reserve raises interest rates, gold often faces pressure because higher rates can make bonds and other investments more attractive. Investors may prefer assets that produce income. Gold does not pay interest, so it can struggle during periods of aggressive rate increases. However, when markets believe interest rates may eventually decline, the situation can change quickly. Lower interest rates can reduce pressure on gold because the opportunity cost of holding gold becomes smaller. Investors begin searching for protection against inflation and currency weakness. This is where gold often becomes attractive again. The Federal Reserve plays a major role in the gold market because every policy decision affects the US dollar and global financial conditions. When the dollar becomes stronger, gold can face challenges because gold becomes more expensive for buyers using other currencies. When the dollar weakens, gold often receives support because international demand can increase. The US dollar remains the world's main reserve currency. But many countries have been looking for ways to reduce dependence on one currency system. This has encouraged some central banks to increase their gold reserves. These purchases represent a long-term shift that many analysts believe could continue to influence gold demand for years. Central bank buying has become one of the strongest stories in the gold market. Central banks are not usually focused on short-term price movements. They think about financial security and national reserves. When they buy gold, they are often preparing for different economic scenarios, including inflation risks, currency uncertainty, and global instability. This is important because central bank demand creates a strong foundation under the gold market. Even when short-term traders sell futures contracts long-term, buyers can continue supporting physical demand. This creates a difference between paper markets and physical markets that investors are watching carefully. COMEX futures are based on contracts representing gold. These contracts allow traders to speculate on future prices, but the physical gold market involves actual bars and coins moving between buyers and sellers. When physical demand becomes stronger than available supply, the market can experience increased pressure. This does not mean COMEX will suddenly stop functioning. It means the relationship between paper trading and physical demand becomes more important. Markets must continue adjusting when real-world demand changes. Gold cannot be created instantly. Mining takes years of planning, and production cannot always respond quickly to rising demand. Another major factor is inflation. Around the world, consumers have experienced higher prices for goods and services compared with previous years. Even when inflation slows down from its peak, the cost of living remains elevated in many economies. This keeps investors focused on protecting purchasing power. Gold has often been viewed as a store of value during inflationary periods. While gold does not always move higher immediately during inflation, it has historically played a role as a long-term protection tool. Investors often look at gold as insurance against financial uncertainty. Silver is also connected to this story because silver has both monetary and industrial demand. While gold is mainly viewed as a monetary metal, silver is heavily used in technology, renewable energy, and manufacturing. Growing demand from industries such as solar energy creates another important factor for precious metals investors. The relationship between gold and silver can reveal interesting market signals. When investors become concerned about economic stability, gold often leads because of its safe haven reputation. When economic growth expectations improve, silver can sometimes benefit because industrial demand increases. Geopolitical events are another powerful force behind gold movements. When conflicts rise or uncertainty increases, investors often seek assets that are not directly tied to political decisions. Gold has historically benefited from periods when trust in global stability becomes weaker. Markets do not only react to current events, they react to expectations about the future. A small change in economic data can create a major move if investors believe it changes the future direction of policy. Employment reports, inflation numbers, and Federal Reserve statements are all watched closely because they can influence expectations. Technical analysis also remains important for gold traders. Investors watch key support and resistance levels. They study trends, moving averages, and momentum indicators such as RSI and MACD. These tools do not predict the future perfectly, but they help traders understand market behavior and possible turning points. A strong trend often attracts more attention because investors do not want to miss a major move. This can create additional buying pressure as more participants enter the market. At the same time, markets can experience sharp corrections because traders take profits or react to changing news. This is why gold investors must look beyond daily price movements. A single day does not define the future of gold. The bigger picture includes monetary policy, global debt levels, currency trends, and physical demand. The current gold environment shows a market caught between powerful forces. On one side, there are concerns about inflation, debt, and geopolitical risk. On the other side, there are higher interest rates and attempts by central banks to maintain economic stability. The battle between these forces is creating volatility, but it is also creating opportunity. Many investors are asking an important question. If gold continues to rise, what happens next? Could prices move even higher as central banks continue buying? Could economic uncertainty create another wave of demand? Or could stronger economic conditions reduce the need for safe haven assets? The answer depends on many factors. If inflation remains difficult to control, gold could continue receiving support. If the Federal Reserve begins lowering rates, gold could gain additional momentum. If the dollar weakens, gold could become more attractive globally. If geopolitical risks increase, investors may look for more protection. However, investors should also understand the risks. Gold does not move in one direction forever. Corrections are normal. Markets can become overextended. Sentiment can become too positive or too negative. Smart investors focus on information rather than emotion. The most important lesson from the current market is that gold is not only about price. Gold represents confidence. When confidence in currencies, economies, or financial systems changes, gold often responds. COMEX cannot ignore what is happening because the forces driving gold are bigger than short-term trading activity. The market is being influenced by long-term changes in global finance. Central banks are changing their approach. Investors are reconsidering the role of hard assets. The world economy is entering a period where protection and stability have become more important. For anyone watching gold and silver, the next phase could be extremely important. The decisions made by central banks, the direction of inflation, and the strength of the US dollar will continue shaping the market. Every economic report and every policy decision could create new opportunities and new challenges. At Silver and Gold Watch, we will continue tracking these developments and explaining what they mean for precious metals investors. The goal is not to predict every single move. The goal is to understand the forces behind the market and make better decisions with better information. Gold has survived centuries of change. It has remained valuable through financial crises, wars, and economic transformations. Today, it is once again at the center of a major conversation about wealth protection and global stability. The market is watching, investors are watching, central banks are watching, and COMEX cannot ignore what is happening to gold. If you found this analysis valuable, make sure to like this video, subscribe to Silver and Gold Watch, and turn on notifications so you never miss the latest gold and silver market updates. Share your thoughts in the comments below. Do you think gold is entering a new major phase, or do you expect a correction ahead? Your opinion matters, and we want to hear your view. Thank you for watching, and we will see you in the next market update. The gold market is entering a period where every major financial decision around the world could have an impact. Investors are no longer looking only at daily price changes. They are looking at the bigger picture. They are asking whether the current financial system is creating a stronger reason to hold real assets like gold. One of the biggest conversations happening among market participants is the growing difference between financial markets and physical markets. Paper trading can move prices quickly because large institutions can buy and sell contracts within seconds. But physical gold represents actual supply and demand. It represents real bars held by investors, central banks, and institutions. This difference has become more important as demand for physical gold continues to attract attention. When more buyers want actual metal, the market must respond. Supply chains become more important. Refining capacity becomes more important. The movement of gold between countries becomes more important. The world of gold is much larger than a single exchange. It includes banks, governments, miners, investors, and individuals. Every participant has different goals. Some want short-term profits, others want long-term protection. Some governments want stronger reserves, some investors want security during uncertain times. This is why gold can behave differently from other assets. Stocks depend heavily on company growth. Bonds depend on interest rates and government credibility. Currencies depend on economic strength and confidence. Gold depends on a combination of trust, scarcity, and history. Another major factor influencing gold is global debt. Many countries have increased borrowing levels over recent years. High debt creates questions about future economic stability. Investors often watch how governments manage debt because excessive borrowing can create pressure on currencies and inflation. When confidence in financial management becomes weaker, some investors turn toward assets that are outside the traditional banking system. Gold has historically been one of those assets. It does not depend on a company generating profits or a government maintaining a currency value. The relationship between gold and government debt is one reason many analysts continue monitoring the market closely. If investors believe debt levels are becoming harder to manage, demand for gold can increase. Another important factor is the changing role of emerging economies. Countries with growing economies are becoming larger participants in the gold market. Rising wealth and increasing demand from consumers can create additional support for gold prices. In many cultures, gold is not only an investment, it is also a symbol of wealth, security, and tradition. Demand from consumers remains an important part of the global gold market. Jewelry demand, especially from major markets, can influence physical demand patterns. At the same time, mining companies face challenges. Finding new gold deposits is becoming more difficult. Developing a new mine requires years of planning, investment, and government approval. Production cannot increase overnight, even when prices move higher. This creates a unique situation. Demand can rise quickly, but supply often moves slowly. When these two forces move in different directions, the market can experience stronger price movements. Investors are also paying close attention to the future of monetary policy. The Federal Reserve and other major central banks are trying to balance economic growth with inflation control. Their decisions affect borrowing costs, currency strength, and investor confidence. If central banks keep rates higher for longer, gold may face periods of pressure. Higher yields can attract investors toward interest-paying assets. But if economic conditions weaken and rate cuts become more likely, gold could receive new support. The challenge for investors is understanding that markets often move before official decisions happen. Gold prices are influenced by expectations. Traders react not only to what central banks do, but also to what markets believe they will do next. This is why every Federal Reserve meeting becomes a major event for precious metals investors. A single statement about inflation or future policy can create significant movement in gold prices. The US dollar remains another critical piece of the puzzle. Because gold is priced internationally in dollars, the currency relationship matters greatly. A weaker dollar can make gold cheaper for international buyers, which can increase demand. A stronger dollar can create pressure by making gold more expensive globally. Watching the dollar index can provide important clues about possible gold movements. However, the dollar is influenced by many factors, including economic growth, interest rates, and global confidence. Geopolitical uncertainty continues to be another major driver. Investors often look for safety when the world becomes unpredictable. Political tensions, trade disputes, and conflicts can increase demand for assets considered reliable during uncertain periods. Gold has earned its reputation as a safe haven because it has maintained value across generations. This does not mean gold rises during every crisis. Market reactions can be complicated, but history shows that gold often becomes more important when uncertainty increases. Technology is also changing the gold market. Digital platforms have made investing easier for more people around the world. Investors can now access information and market data faster than ever before. This increased access means more people are paying attention to precious metals. A major price movement can spread quickly through financial communities and create stronger market reactions. However, successful investing requires discipline. Fear and excitement can both lead to poor decisions. When gold rises sharply, some investors rush in because they fear missing the opportunity. When prices fall, some investors panic and sell too quickly. Understanding the market cycle is essential. Strong assets can experience temporary declines. Weak assets can experience temporary rallies. The goal is to understand the long-term forces driving the market. Gold remains one of the most closely watched assets because it sits at the intersection of finance history and global economics. The current environment combines inflation concerns, currency questions, central bank demand, and geopolitical uncertainty. This combination is creating a situation where every major market participant is paying attention. The next major move in gold could depend on several important questions. Will inflation continue slowing or return stronger? Will the Federal Reserve begin reducing interest rates? Will central banks continue increasing their gold reserves? Will global uncertainty create more demand for safe assets? These questions will shape the future direction of gold. For investors, the key is preparation. Markets reward those who understand the forces behind price movements. They punish those who react only to headlines. The gold story is not only about a rising or falling price. It is about a global shift in how people view money risk and security. The world is changing, and gold continues to remain part of that change. Whether prices move higher or experience corrections, the reasons behind those moves will always matter. That is why understanding gold today requires looking beyond charts. It requires understanding economics, policy, and human behavior. The market is sending signals, and investors are listening carefully. COMEX represents one part of the gold world, but the bigger story is happening across global markets. The future of gold will be shaped by decisions made in central banks, government offices, financial institutions, and by millions of investors around the world. The next chapter of the gold market could become one of the most important stories in modern finance. As we move deeper into this changing gold environment, one thing becomes clear. The gold market is no longer driven by one simple factor. It is being influenced by a powerful combination of economic trends, global decisions, and investor behavior. The biggest mistake many people make is looking only at the current gold price. They see a number moving on a screen and forget that behind every move there is a story. There are millions of decisions happening around the world that shape the direction of gold. A central bank adding gold to its reserves is a decision based on long-term strategy. An investor buying a gold coin is a decision based on protection. A trader opening a futures contract is a decision based on expectations. All of these actions combine to create the market we see today. This is why understanding gold requires patience and a wider perspective. Many analysts believe the role of gold could become even more important in the coming years because the global financial system continues to experience major changes. The balance between currencies' interest rates and government debt is creating new challenges for investors. The traditional idea of money is also changing. For many years, people trusted currencies because of economic strength and government stability. But periods of inflation and financial uncertainty remind investors that purchasing power can change over time. Gold represents something different. It represents an asset that has existed outside modern financial systems for thousands of years. This does not mean gold is perfect or that prices only move higher. Gold can experience corrections. Gold can move sideways. Gold can surprise investors. But the reason many people continue to watch gold is because of its unique role during uncertain times. One important factor that could influence the next major move is investor confidence. Markets are built on expectations. When confidence increases, investors may move toward riskier assets. When confidence declines, they often search for stability. This cycle between risk and safety has always been part of financial markets. The same pattern can be seen when looking at previous economic challenges. During periods of banking stress, currency concerns, or geopolitical tension, gold often attracts attention because investors want something they believe can preserve value. Another important factor is the relationship between gold and real interest rates. Real interest rates measure the difference between interest rates and inflation. When real rates are low, gold can become more attractive because holding cash or bonds may provide less protection against inflation. This is one reason investors closely follow inflation reports and Federal Reserve decisions. These numbers provide clues about the future direction of monetary policy. Every inflation report can change expectations. Every Federal Reserve comment can influence market sentiment. Every economic slowdown or recovery can create new pressure on gold. The future of gold will also depend on supply. Mining production is a slow process. A new mine can take many years before it produces significant amounts of gold. This means supply cannot quickly adjust when demand increases. This limited supply growth is one reason gold remains valuable. Scarcity plays an important role in every market. Silver also deserves attention because it shares many connections with gold while having its own unique demand factors. Silver is used in technology manufacturing and renewable energy projects. As industries continue developing, the demand for silver could become an important part of the broader precious metals story. Many investors follow the gold-silver ratio to understand market conditions. This ratio shows how many ounces of silver are needed to buy 1 ounce of gold. Changes in this relationship can provide clues about investor demand and market sentiment. When fear dominates markets, gold often becomes the main focus. When economic growth expectations improve, silver can sometimes gain stronger momentum because of industrial demand. The precious metals market is constantly changing, but one theme remains consistent. Investors want confidence, they want stability, they want protection from uncertainty. This is why gold continues to attract attention from individuals, institutions, and governments. Looking ahead, investors should continue watching several major signals. The direction of the US dollar will remain important. Federal Reserve policy will remain important. Inflation trends will remain important. Central bank buying will remain important. Global events will remain important. These factors will help determine whether gold continues its strength or enters a period of consolidation. No one can predict every move in the market with complete accuracy. Even professional investors understand that uncertainty is always part of investing, but by understanding the major forces behind gold, investors can make more informed decisions. The biggest opportunity often comes from knowledge. Understanding why markets move can help investors avoid emotional decisions. Gold is more than just a metal. It is a reflection of confidence in the financial system. When confidence is strong, investors may focus on growth. When confidence weakens, they often look for protection. That is the deeper story behind what is happening with gold today. COMEX cannot ignore these changes because the forces driving the gold market are global. They involve governments, central banks, institutions, and millions of investors. The next phase of gold could bring major opportunities but also major challenges. Investors should stay informed, remain patient, and understand the bigger picture. The gold market is telling a story, and that story is still being written. At Silver and Gold Watch, we will continue following every major development in gold and silver markets. We will analyze the economic data, the policy decisions, and the market movements that matter most. If you believe gold is entering a new era, let us know your thoughts in the comments. Do you think central bank demand will continue pushing gold higher, or do you believe the market needs a major correction before the next move? Your opinion is important, and the conversation helps everyone understand the market better. If you enjoyed this analysis, make sure to like this video, subscribe to Silver and Gold Watch, and turn on notifications for more professional gold and silver updates. The world is watching gold, investors are watching gold, and the next major move could reveal just how important this precious metal has become in the modern financial world. Thank you for watching, and we will see you in the next market update.